Welcome to Building Better Communities with Bob Hart, the podcast that dives into the stories of the leaders in commercial real estate and beyond as they talk about their careers, the market, and what it takes to build better communities. On today's episode, Larry Taylor, founder and CEO of Christina Development, joins Bob on the podcast. Now for your host, Bob Hart.
Welcome to Building Better Communities with Bob Hart. I am your host, Bob Hart. Today, I'm very excited because I have my friend and colleague here, Larry Taylor of Christina Development, who's the guest on today's podcast. Welcome, Larry.
Thank you, Bob. Glad to be here.
Nice to see you, my friend. So today's conversation is going to be about how Larry built his almost 5-decade career and how his company has anchored the Westside commercial real estate space. And he'll talk about some big deals he did over the years with people like the iconic Jerry Buss, the owner of the Lakers. He'll talk about how the investment business has changed over the decades and why he continues to work to build better communities in Los Angeles, and particularly on the West Side. Let me tell you a little bit about Larry and his background. He came from humble beginnings in Pennsylvania, moved to California when he was a young man, I think around 10 or 11.
10.
And lived in an apartment in the Fairfax district. Later on, he founded Christina Development after he graduated from USC, or maybe even during while he was at USC.
During.
In 1977. And I think he worked as an accountant for a couple of years, too.
A couple of months.
Couple of months, okay. But Larry's been investing his money and the money of others for over 4 decades in the real estate in the West Side region of LA. Some of his notable projects include high-rise residential development in Century City, the development of the Montana Ave Shopping District in Santa Monica, revitalization of South Beverly Hills Retail Shopping District, redevelopment of Westwood Village, and I believe a very successful project in the Larchmont area as well.
Recently.
All very high-end areas of the city. As I mentioned earlier, Larry had a brief career with Ernst & Young, and he received his bachelor's degree from the University of Southern California in 1975. Now let me tell you a little bit about his company, Christina Development. Christina is a Malibu-based real estate developer who's a manager and sponsor of deals. It was founded in 1977 when you graduated from USC. So for those 47 years, he has successfully sponsored investments throughout the West Side of LA in about 8 different suburban markets: Beverly Hills, Brentwood, Century City, Malibu, Santa Monica, Silicon Beach, West Hollywood, and Westwood. Christina Development, through its unique investment vehicles, provides qualified investors with the opportunity to participate in the ownership of investment properties in these ultra-prime areas of LA. The firm has been featured in Bloomberg, Forbes, LA Times, and Yahoo Finance. So here we are, Larry. Good to see you.
Thank you. Great to see you, Bob.
Okay. So I'd like to start by sharing why I'm personally thrilled to have you join us as a guest on my podcast. Larry and I met in the early 2000s when I was just learning how to spell real estate, and I was running Kennedy Wilson Multifamily. And I had the pleasure of meeting him because you tried to buy my very first deal there. Do you remember that?
I sure do.
You did.
I should have.
You showed up. And although he didn't go through with it, it was quite an exciting process. So that's where I think I learned all about you and your company and so forth. So it's a pleasure to be friends with you for the last 24 years.
Seems like yesterday.
Not that long ago. So let's continue here. Talk about how Christina got started. We're going back to 1977. What did the early part of your career development look like? Obviously, you've been an entrepreneur the whole time.
That's true, but
you've never worked for anybody.
No, except for a very brief period, as you mentioned, EY, which was Kenneth Leventhal then. And the only reason I was a Kenneth Leventhal is I grew up with the Leventhal's.
Interesting.
With Ron Leventhal, who was Ken's nephew, and Ross, who was at USC with me. So I was destined to become a CPA. I went to the #1 accounting school, USC. My path was already predetermined. and I was a scholarship
Did your
student.
parents want you to be an accountant?
They didn't know what I was doing. I was always entrepreneurially doing something. They just didn't understand what it was that I was doing at any point in time. Because I wasn't a lawyer and I wasn't a CPA, they were very disappointed. But I think that what they did understand was that I had a knack for making money. And that goes back to when I was 11 years old and figured out.
Tell me about that.
Oh, yeah. At 11 years old, I discovered that kids that were standing on street corners selling newspapers, which is the old Los Angeles had the Herald Examiner
Yeah.
and the LA Times. And the Herald Examiner came out in the evenings, and the LA Times came out in the morning. So the Herald came out in the afternoon, and at 4 o'clock, boys would stand on street corners and hold up the newspaper to cars in traffic, and cars would roll their windows down and give you a dime and take a newspaper.
On the busy streets.
Yeah, on all the busy corners.
Wow.
And the paper boy, me, I could keep 3 cents for every paper that I sold. And I was so good.
What was the cost of the paper?
10 cents.
That's a pretty good commission.
Not bad. Well, they were making money in other ways, obviously.
Did you have to advance the cost of the papers, or
No.
were they giving you on
No,
stack?
you showed up a half hour early, you got your stack,
Yeah.
and then I stood on the corner of Santa Monica Boulevard and Fairfax, and I would walk down the middle lane, and I would tell jokes. And people started to come up Fairfax just to see the paper boy that told jokes. And the average corner was like 30 papers. I was selling 70 or 80
An afternoon or
in
a
an
day.
afternoon. I was racking in 80 papers times 3 cents. It was a lot, right?
Wow.
Every day. So after a while, I started finding other kids in the neighborhood. I would build up a corner, and then I would sell them the corner, saying,
Like a franchisee.
this corner is doing 80 papers. You're lucky to do 30.
Well, what, could they tell jokes, though?
No, but I already had the clientele.
I see. Okay.
So I just took a penny.
So you took a rake.
I took a rake, and then I took the next corner,
Yeah.
and the next corner. So I had all 4 corners of
Oh, my
Santa
God,
Monica
Larry,
and
that's
Fairfax.
a great story. I never knew that about you.
Yeah, and I was, remember, my dream was to be a stand-up comic.
Was it really?
Yes. I
Wow.
wanted to be a stand-up comic. I had no interest. I mean, that was my shtick. And I was practicing it on these people that would roll down their window, and and I always had something funny, and I
That's
built a
great.
clientele. So
You are kind of funny.
I was. I mean,
You're still funny.
I'm less funny now when real estate's down, but when things are good, I'm more jocular. But I was always into something, and then if the papers didn't sell at 6 o'clock, you got to take home whatever papers were left. So then I had a bunch of people that lived on Ogden Drive that couldn't
Near your
afford,
house.
that couldn't afford the subscription. So I would sell them the paper for a nickel.
So you gave him a discount.
Yeah, yes, of course. It's
Did
half
you
price.
you didn't make the 3 cents on those, though, did you?
And I got those free.
Oh, you got those free because they were just
what are you
extra.
what could you do with the papers when they were unsold?
Sure.
So I would just walk through all the every building, 8, 10, 12 unit buildings, and I would just knock on the door and say, "Do you need a paper? Did you get a paper? Here's a paper you can have for a nickel."
Really?
Yeah. And I saved up enough money to buy a Schwinn bicycle
Back in the day.
back in the day.
Okay.
Yeah, it was a big deal.
Now, I know personally that you're the son of Holocaust survivors.
Yes.
And you grew up very humbly in Pennsylvania. I think was it rural Pennsylvania?
Very rural. Coal mining.
And your parents moved here for a better life and, lived in what might be considered crowded conditions.
Very dismal.
Tell us how that shaped your view toward life and do work and all that.
It was very interesting because I had 2 sisters. One passed away, but my sisters were born in Germany, as my parents, after World War II, were waiting to become admitted into the U.S. as refugees.
This is in the 50s?
This is in the 40s,
40s.
into the early 50s. So from 45 to 52, they waited 7 years in Germany to be admitted to America because they had no living relatives in the world, and they had nobody in the U.S. that would sponsor
Because
Jews.
they had been lost in the Holocaust.
Yeah, everybody on their families had been murdered. And they found each other.
Polish immigrants?
Polish.
Polish immigrants.
And so there was this Jewish congregation in Pittsburgh called the Tree of Life. And they found a job for my dad in this coal mining town known as Uniontown, which is where I was born.
Uniontown, Pennsylvania.
Uniontown, Pennsylvania, which was a coal mining town.
Is that in western Pennsylvania, or where is that?
It's not far from Pittsburgh.
Okay, western Pennsylvania.
And it's close to West Virginia, so
Yeah.
geographically it's kind of
Southwest.
in that southwest. And so, my parents came over here with my two sisters on a boat, and they simply went where they were sent. And
Of course, that's how it worked.
that's just how it worked, and we ended up in Uniontown, which was maybe at that time a population of 17,000. Most of the people in the town were involved in the coal mining business or some relation to that, whether it was trucking, whether it was processing. And the coal mines in that area were already giving out. There were a lot of unemployment, and this was a very, very lower middle class
Yeah.
town. And I was the only...
Kind of the part of the Rust Belt of America, if you will.
Right, but it was already rusting in the 50s,
Very
right?
close to Ohio and a lot of the steel mills and so forth.
Yes, that's where I ended up, and so I grew up, in what I would call a very rough and tumble Italian Catholic neighborhood.
Multi-ethnic.
And that was my upbringing, which was all about, tough stuff.
Well, learning how to navigate and survive at an early age amongst others.
Yes, and the others didn't take kindly to me because my parents were about the same age as their grandparents. Because my parents had families before the war that were murdered, so they were starting over. So today,
Interesting.
a man who's 53 years old and has a newborn is not that odd. In the 50s,
Yeah, that
when
was
when
unusual.
kids were getting married in their teens and early 20s, by the time they were 35 or 40, their kids were grown.
Okay. So
And
you
their
had
kids
older
were having
parents.
kids by the time they were in their 50s, whereas my parents were the same age as everybody's grandparents.
Interesting.
So it was a very kind of an odd time, an odd place.
Yeah.
I always felt like, and I was very discriminated against, I will say, because my parents spoke a funny language, because I was Jewish, although I never really understood that, because that wasn't part of our life at the time.
Yeah.
I grew up going to church. I went to confession.
Really?
Oh, yeah. Oh, yeah. I didn't even understand anything except, church and Catholicism.
Wow.
And my best friend's brother was a priest. And there was a church almost on every block in this little town. And so, but I was miserable. I was just miserable. And I just knew that somehow I didn't belong there. And I would only pray that someday I could get out.
Well, all that praying must have worked.
It did.
We're doing that now in the real estate market.
I'm good at praying.
Jeez.
Yeah, it was tough, but it toughened me up.
Yes. Well, let's talk a little bit about, it certainly did, and it certainly formed a foundation for what you're doing. So you sell the newspapers, you go through high school, Fairfax High, you then move on and you're accepted to USC at a very good accounting program there
Actually, it wasn't quite that easy.
to get in.
No, to get to
get through
SC,
it.
because
Oh.
again, so all the way through my existence coming to Los Angeles, I was doing anything entrepreneurially I could do to make money. I mean, anything. So, my first real estate deal was buying an apartment building when I was 11 or 12.
Come on. How'd you
Oh,
do
yeah.
that?
Well, I was living in a 2-bedroom, 1-bath apartment with 2 sisters who were older than me. And you know what it's like to wait for the bathroom? You gotta go, you gotta go. Girls never get out of the bathroom.
How did you find the wherewithal to do that?
I picked up the phone and called a realtor whose same name I saw on a sign and said, I need a house. And that was in
Really?
1966.
So how did you scramble the money together?
Well, my parents had savings of about $4,000.
Uh-huh.
And I called up this broker, and he came to pick me up, and he said, now, what are you looking for? And I said, I'm looking to get out of this apartment because I grew up in a house, and I can't live like this. And so he said, well, why would you want to buy a house when you could buy an apartment building? And I go, I just told you, I want to get out of an apartment building. And he said, but you can buy an apartment building that actually has a 3-bedroom, 3-bath apartment, and that's called the owner's unit, and you might have 9 or 10 other people that'll pay rent. And they'll pay rent to you, and then you can live for free. All you have to do is manage the building. And I went, that's impossible. Live for free in a 3-bedroom unit? So that was really my first real estate experience. And I could get into the details of that.
So did you do that with your parents?
My parents had to sign,
Yeah,
right.
I got it.
Yes, and so...
But you were the an impetus behind it.
I was. And that was a very interesting transaction, a profitable transaction, which led to the ability to make enough money to buy the first house.
After that?
After that, when I was 13 and a half.
Just from the cash flow?
Yes.
From the building?
Right. We were able to buy a house.
What street was the first place on? Do you remember?
Holt and Olympic.
Holt and Olympic, okay. Down sort of near La Cienega there.
Very, very close to a building you're familiar with.
Yes. I think I own it now. That's why you're so fond of that area.
Well, I knew the area quite well. And then I negotiated the purchase of a house on Colgate and Crescent Heights, which was high-end compared. It wasn't the best house. It was the worst house on the best block, but it was cheap. It was only $29,250. Got it down from 31. And and it had an assumable loan. This is where I really learned that, if you can take over a 5.25% mortgage with the Caldwell Company, and all you have to do is tear the coupon out and send it to them with your check for $195, you're in good shape.
Back in those days of real estate, didn't people also do wraparound mortgages, AITDs, where they would wrap around an existing mortgage sometimes?
The wraps came later.
That was later.
Yeah, the wraps came after Wellenkamp v. Bank of America, if you remember that.
No.
So there was, in the early to mid-'70s, there was a landmark Supreme Court case, which was based upon Wellenkamp, who was a single-family homeowner who sued Bank of America when Bank of America accelerated his loan when he sold the house to another buyer and didn't tell the lender.
Right.
And the buyer just was making the payments, and the lender exercised its option to call the loan. And
was Wellenkamp the
Wellenkamp was the plaintiff.
The plaintiff.
The plaintiff.
He bought the house from the other party.
Right, and Bank of America foreclosed, or tried to foreclose. The case went to the Supreme Court, and the Supreme Court decided that a bank cannot call a loan based upon a due on sale provision just because the property transferred if the sale of the property was for a higher price than what the previous buyer paid for it.
Because the bank wasn't impaired.
Exactly.
And they still had all their foreclosure rights and everything else.
Yes, but they had no right to call a loan on impairment if they're not impaired.
Yeah.
And
now they're probably more sophisticated because of transfer provisions and everything else.
Well, yeah. Well, the Garn Act, which passed, I think, 4 or 5 years later, kind of changed the rules, and that's kind of the end of the wraps, so to speak. But so in those days, it was very, very simple. We didn't have to tell the lender. Sellers could carry back mortgages. You could do all-around wraps and things like that, and never have to discuss anything with the first trustee lender. So
what were the early years like for you when you started Christina, and then obviously after USC? How did it begin? Like, what were some of the things you were doing back then?
In 1972, the California Coastal Commission came into place. In fact, the legislator that actually put that together recently died, Alan Cerroti.
Alan Cerroti, I remember that name.
He just passed away in 92 or 3, and he was essentially gave birth to the Coastal Act. And I was still in college at the time and had learned a lot about land and entitlements. And it dawned on me that if you had a property that was entitled with a Coastal Commission permit, it had to be worth more money than a non-entitled property. And this is partially educational and partial sense. So I met, when I was in college, one of my close friends at the time was a guy by the name of Jeff L. Tinge, whose father owned a bank called Imperial Bank, which California was a big bank.
Yes,
if you remember.
Imperial Bank.
But George L. Tinge and George Grazadillo were real estate guys. They made their money in real estate development. And one day, Jeff said, the bank was foreclosing on all of these lots in Malibu and the project across from Pepperdine, Malibu Country Estates. And the beauty of it was exempt from the Coastal Commission. And so we went out to visit his dad, who happened to live on the beach at that time, which was something very, very new to me, that people could live on the water. And they were selling these tiny little lots to us for like $28,000.
Wow.
And the bank said, don't worry, we'll finance the construction and so on and so forth. And you don't have to worry about permits because we're exempt from the Coastal Commission. So I said, well, what does land that's not exempt sell for? So you could buy an acre in Malibu for $10,000.
Then
instead of a postage stamp for $28,000. The problem wasn't
entitled.
Didn't have a coastal permit. So then I set about thinking, what does it take to get a coastal permit? And so I became the coastal permit genius during those years. I was actually still in college. And I carried that through for a while. It wasn't until '77 that I actually started getting into multifamily.
So the value add of what you were doing there was understanding how to work around basically regulation.
How to deal with governmental agencies to take a property and make it more valuable by getting it entitled to do something with it rather than having it lie fallow.
And I'm sure that's carried forward for you. But let's talk about the kind of the mid '70s and the early '80s. That was a time that we really gave rise to syndicators. You were a younger contemporary of folks like Donald Sterling, Jerry Buss, all of which I think you've had deals with. But that was a difficult time because as we were passing into the '80s with Jimmy Carter, it was a very high inflationary period. I think rates were approaching 20% for real estate.
Yeah, over.
Yeah.
More, higher.
Yeah. And then
at one point.
I believe that was the era of Paul Volcker as well, wasn't it?
That was Mr. Volcker who decided to break the back of inflation, and he did.
And we talk about him today in parallel with our current Fed chair and how they're both behaving, Jerome Powell. But were you then starting to be more of a sponsor where you were bringing in other investors, and were they getting the benefit of what was available then, which is the passive losses generated by real estate? Because I know was an important part of syndication back in those days.
It was very important at that time. I didn't really come to terms with that because early on, I had met Sam Freshman, who wrote the book Principles of Real Estate.
Freshman, yes.
Sam came to speak to us at USC, and he autographed his book, Principles of Real Estate Syndication 1. But I never really paid attention to it. But I had a taste of apartment buildings when I was very young, as we just discussed. And so I started looking at and buying apartment buildings and figuring out a way to buy them on my own. So I had my short-term lender and my long-term lender. B of A was my short-term lender. Home Savings was my long-term lender.
Okay.
And so I had relationships with these two banks. I would borrow short-term for the down payment and borrow long-term from Home. And then I would find a building that I found that was undervalued. Actually, I started in what is now Koreatown. My first two buildings were 239 Commonwealth and 954 South Carondelet.
Wow. Let me ask you, were you borrowing a first and a second, or were these unsecured loans?
First was secured, second was unsecured.
Interesting.
Yeah, and I was able to talk the bank into my program, which was I'm going to buy it, I'm going to improve it, I'm going to raise the rents, and I'm going to sell it.
So you're doing structured finance before they called it structured finance.
Exactly. I mean, there's nothing new. It's value add now.
Now it's value add.
Right?
Now we're not supposed to use that much leverage.
Yeah, and I call it value bought, but in any event, I was doing very well. I tried to explain to my mother how successful I was because I quit Kenneth Leventhal after 7 weeks. I didn't become an attorney. I was a nobody in her book because what was I doing? But I was explaining to her that in my first couple of years, I think I earned about $250,000 per year.
Back in the
70s.
That's a
And
lot of money.
I said, Mom, the president only gets paid $200,000 a year.
I don't even know if it was that much then.
I'm doing better than the president. And she never really bought into it until I bought her a condo in Century City.
But you were reinvesting your money. I mean, a lot of things going on.
Well, what I would do is I would finish the building, sell it, and then I would go find another
another one.
building.
Yeah.
And that's when I met Jerry Buss, who taught me the syndicate.
How did you, Jerry? Did he teach at USC or did he go to USC?
No.
He was from Wyoming, right?
He had a PhD. He had a PhD in mathematics.
Chemistry. Oh, mathematics.
Mathematics.
Yeah.
And he and his two partners, Frank and Bob Mariani, were all in the aerospace world. And that was when federal tax rates were 70% and in some cases 90%,
Right.
plus California tax.
And that's why tax shelters were so popular.
And aerospace engineers at that time were the highest paid professionals in LA County.
Yeah.
And so they needed shelter. And so when Jerry was an engineer, he started putting together these partnerships to buy apartment buildings and pass these losses through to the engineers and save them money on taxes. And so a friend of mine was working for him in his property management division, and I went to visit one day and met Jerry. And Jerry was very interested in me because I was very young and had my own company. And he said, now tell me how you structure your deals.
Yeah.
And I didn't know what he was talking about because what's the structure? You go to the bank, you borrow the money, you buy the building, you fix it up, you sell the building. He said, well, that's linear.
Interesting.
What does linear mean? He says, well, because you have to sell a building to make the money to buy another building. Let me show you what we do. I go, what do you do? And that's when he handed me his PPM, his private placement memorandum. He said,
Yeah.
Larry, people invest in real estate for reasons other than making money. And I'm thinking to myself, I think he's a lunatic. Why would you invest in real estate and not make money? I had never thought about the tax aspects.
Mm-hmm.
And so he said, well, there are people that invest in real estate because they want to save money on taxes. There's people that invest in real estate because they want to grow their wealth. And there's people that invest in real estate because they want the cash flow. And everybody needs a manager. Somebody's got to run the thing, and that's what we do. I go, oh, that's interesting.
So he taught you a different formula. I don't know if you saw the series on HBO called Winning Time
I did.
about the rise of the Lakers. There was a very famous scene in there where after, Jerry got going and he and Frank were starting to make some real money, and they were trying to buy the Lakers from Jack Kent Cooke.
I remember those
They were
days.
sitting there at a lunch in the scene, and Jerry's offering him some shares or the deeds to his buildings as a way to buy his professional sports team. And I think ultimately it worked, didn't it? Isn't that how he
was.
did it in part?
I was around in those days, and
What was that like?
well, Jack was failing. Jack was mercurial. He built the
Yeah.
Forum. I mean, he owned the Lakers. He owned the Kings. He was quite out there as an entrepreneurial and a visionary. He also was out on the limb, and he needed money.
Mm-hmm.
He didn't need real estate. He needed cash. And Jerry wasn't able to work out a deal to trade real estate for the Lakers, the Kings, and the Forum. He needed cash. And so he turned to some of his trusted friends and buyers, and I bought a number of buildings from Jerry, and Donald Sterling bought a number of buildings from Jerry to give him enough money to close the deal, which I think was $67 million.
Interesting. Both those iconic men became owners of professional sports teams,
Yes,
all
and-
from owning real estate.
Yes, and the two of them got together with me one day and said, Larry, we want you to buy the Pacers.
Really?
I said, I don't know anything about
Where
basketball.
were the Pacers playing then?
Indiana.
Oh, in Indiana even
Yeah,
then? Okay.
buy the Pacers.
Okay.
And so I'm sitting there with Jerry and with Donald, and they say, you've got to buy the Pacers. It's $5 million.
Back in that day.
Yeah. Well, the Clippers were maybe $9 million with $4 million of deferred salaries. So the real price was $5 million. He was behind on the salaries. And so when Sterling bought it, he got the benefit of the $4 million tax deduction.
Interesting.
So I said, I don't know anything about basketball. And Jerry said, neither does he, pointing at Don.
Yeah, they learned quickly.
And years later, many, many years later, I run into Sterling after he'd sold the Clippers, the forced sale for $2 billion, and he said, you should have bought the Pacers. Look what I did. I just made $2 billion. And I went, yeah, fine.
He did it his way. What happened was unfortunate, but nonetheless, he did very well on it. So now it's the 80s, and you're getting going. We're kind of coming out of the 1986 era where the Tax Reform Act passed. So the party was phasing out of using these passive losses. The Tax Reform Act.
We called it the Tax Deform Act.
You called it the Deform Act.
Right.
Okay.
But remember, we went through the Vulker Era with rates at 21 to 24%.
Yeah.
The economy crashes.
These things are happening in 4 or 5 year increments too. Not like today we have long cycles. You had much shorter cycles, because if you really look at it, you had the Volcker period with the higher rates, the Volcker-Reagan period, the Tax Reform or Deformed Act, as you called it, and then we get into the early 90s, we have the thrift and loan meltdown from the deregulation of these small banking institutions, which led to the formation of the Resolution Trust Corporation in '89. So that's a very volatile period of time.
But it was very opportunistic at the same time.
Talk about what you were doing on the West Side then. How did you navigate that?
Well, timing was everything. So in talking about 5-year increments, the rate of inflation in real estate values from 76 to 79 was extraordinary.
Was it?
Well, we had double-digit inflation.
So rents were growing.
And real estate was going up like crazy.
So even though you had high rates, you had high growth.
High growth. And we didn't have
so
super high rates. Rates were in the 8s to 9%.
They were.
It was only in 1979, 80, 81.
We had the hyper.
That's when Volcker was moving the rates up almost every day, it seemed like. Very, very rapid rise, okay? And this was during the Carter administration. And so I saw rates moving up, and I also saw how much real estate had gone up. I was making so much money in such a short amount of time on real estate, but I could see that the tide was turning as the rates were moving up. And at a certain point in time, as we both know from our industry, it was no longer accretive. You couldn't buy the buildings and finance them at those rates, even at 9. So I sold. I was out in 1980.
In 1980?
80. Out.
You sold your holdings?
Out. So when 81 came along, except for one property, which was challenging because I was stuck on a variable rate loan with B of A, but I got through that, barely. But Reagan came along and rates went down to 12, and I had started buying in 81, and the buildings that I bought in 81 that I had to put 50 or 60% down and borrow at 18%.
Wow.
With 7 points, which was a good deal.
7 points?
Yeah.
That's
all state savings, 18%, 7 points.
God. But let's talk about it. You were investing not just in apartments. You were a big investor in retail
and office.
And office.
Yes.
Talk about your early strategies. Talk about how the West Side looked back then.
There was still vacant land. So there was still,
it wasn't infilled like it is now.
No, there was still opportunity to build, which was in a way good and in a way bad because you had potential for competitive properties to be built, but you also had rent control that came in 78 and 79.
Right.
So rent control started to change the entire landscape.
It was October 1st, 1978.
Yes, and then following that was Santa Monica, or it was Santa Monica first, I don't remember.
Santa Monica and West Hollywood had the more stringent rent control.
Yeah, well, West Hollywood, not till 85 when they became a city.
They became a city, right?
Right. So, I mean, a lot of things were changing at that period of time, and you're right, it was a very tumultuous time period. So I started buying apartments that were rent controlled because I was buying them for $30,000 a unit, 2 to 4 blocks from the beach.
Amazing.
Yeah, $30,000 a unit when a condo next door was selling for $150,000.
That would be
And
the
I thought to
closing
my-
cost today. My God.
I know, 30,000. That was it. 30,000 a unit was my buy. And then every time a tenant would move, I would just lock the door and throw the keys away and never re-rented.
Because it was rent stabilized.
Yeah, and I figured the land underneath was worth more than the building, so what do I need the
Interesting.
tenant for?
Interesting.
So
So
it's
you were
just,
land banking. It was like a covered
yeah,
land
in
play.
other words, but at SC, when I was at USC, we studied rent controls and price controls. And historically, price controls and rent controls didn't work, and they would come off. So I was betting that I'll buy these buildings and that someday rent control would go away. That did not happen.
Not after October 1st,
No,
1978.
that did not happen. But those buildings that we bought for $30,000 a unit, we sold for $85,000, regardless. And those same units today sell for about $450,000 to $500,000 or $600,000.
Took a lot of guts and a lot of vision. So, Larry, we enter a period after the tumultuous 80s and early 90s of expansion in the 90s. Other than a brief bubble, which was the dot-com bust, I'm not sure even how much that affected real estate down here from kind of March of 2000 to 2002. But we really entered a long period of good growth for this part of the country. Talk about your strategy a little bit in the West Side and the neighborhoods you picked and some of the projects maybe that you've been involved with, because I think that'll be interesting to the viewers.
Well, I had become a syndicator. I had only invested in the West Side on behalf of clients, and I became a professional sponsor. And I took sponsorship very seriously, meaning I didn't buy real estate for my own account. I was strictly a professional and strictly looking at and acquiring, owning, and operating West Side investment real estate because Jerry Buss taught me, don't lose your investors' money.
Yeah.
You know the old saying, if you make money, they don't say thank you. If you break them even, they never invest with you again. And if you lose their money, they'll sue you. So
it was a flight to quality.
there's always quality. Don't lose their money. So I was a significantly successful syndicator throughout the 80s. I sold everything before the 91 crash. So now,
Yeah. How did you see that coming?
same thing. I was just reading the tea leaves. The values had run up so great in the 80s.
Yes.
There was no reason to not sell. And so, sometimes, just things dictate. When people are coming to you offering you prices that you think are more than the properties are worth, you sell.
Yeah. Well, there's a lot of liquidity in the system through these small thrift and loans that were all deregulated.
Well, it was definitely a go-go time for S&Ls. S&Ls became real estate investors and real estate developers because they were deregulated.
Right. You had CalFed, Home
But
Fed.
there were failures too because American Savings and Loan failed in 1984. And
Was
they
it
were
that? Was
yes,
that-
and they were the largest S&L in the country. And that's when State Savings and Loan, which was a tiny Stockton-based S&L,
Yeah.
bought American Savings, which was the biggest S&L. The small guy bought the
Yeah.
big guy, not unlike Bank of Cal and
Pacific Western.
and Pac Western. And they were doing they were running watch lines selling $100,000 CDs across the United States because they were insured up to $100,000. They had all these things going on in the S&L industry, and a lot of this was promoted under the Reagan administration. So you had what I call the go-go period, and we also had privately or publicly traded limited partnerships. I don't know if
MLPs?
you recall that. No, publicly traded LPs.
Publicly traded
Yeah,
LPs.
like JMB, for example, was a publicly traded limited partnership. Where the
Which was another form of syndication.
yeah, but these were sold to the public.
On the market.
There was a market. There was a trading market for it.
Yeah.
And so the publicly traded limited partnership business grew out of the unique and special giveaways to real estate, specifically apartment buildings. Because apartment buildings under the 81 Economic Recovery Act were given bonus depreciation that they did not have to recapture on sale.
That they did not have to recapture.
No recapture.
Wow.
So just to put things very simply, if you bought an apartment building for $10 million in 1982 and you sold it in 1985 for what you paid for it and you were at a 50% tax bracket, you doubled your money.
It's amazing. I never knew that.
So you had this go-go time period. And as the 86 Act passed, it was evident that the party was going to be over, but the law didn't change in 86. It changed in 80, it was 80%. They phased 80, 60, 40, 20, and 91. No more tax benefits and no more savings and loan industry.
Right. But now you have other crises looming in the system. You have the junk bond crisis, which led to the fall of Drexel in early 1990. Right behind that was Executive Life in 91 with Fred Carr, which I was involved with the rehabilitation of that for several years. It must have been like the Wild West out here. So how did the west side of LA hold up, this flight to quality, this Jerry Buss's tutelage of you?
Yeah.
How did you navigate that?
Well, this was the first time that we had a lower low than any previous dip, where the prices in 91 actually dropped below the previous low. And when I say things were cheap, I'm telling you, office buildings on the west side, A-quality buildings are $80 a foot.
My God, now we're getting nervous about buying 5.5 caps, looking against high values of 3.5 caps from 2 years ago. Amazing.
It was the Wild West, and there were some very...
Had to be, yeah.
But there were some very smart guys that took advantage of it. I went to Wall Street because I could not raise any more money as a syndicator, because without tax benefits, that whole
thing got shut off.
My whole group was no longer interested in investing in real estate.
So the whole era of cash flow investing on real returns really began after that.
Yes.
It wasn't just on shelter or pro forma or hope certificate. It was really on true durable cash flow.
It changed dramatically, because once the government took away the incentives, they even took them away for real estate operators, meaning that, guys like us that were sponsors, we couldn't take the losses from real estate and deduct it against our ordinary income.
Right.
That was like, are you kidding me? And, I stopped working from 91 till 93, essentially, because I couldn't use I just thought the world was crazy.
Yeah, so you sat out.
Yeah, well, when I say I sat out, I was like,
Yeah.
what do you do next? And that's how I ended up with Wall Street. I didn't even think that...
So you pivoted.
I pivoted.
So it's not always been just private equity.
No.
And you were involved, I think, as I remember, Payne Weber was one of your investors?
Payne Weber, which became UBS.
Yes.
DLJ briefly, which became Credit Suisse. And Warburg Pincus. So those firms from, say, 92, 93 to 2006 were really my primary sources of equity.
Interesting.
And it was
but they were willing to do Westside deals and these boutique kind of deals.
I had the track record, and I had that unique knowledge of the West Side. And I was able to somehow or other talk my way into it, to be honest with you. But
well, that's how I met you in early 2000 when I was at Kennedy Wilson, when I was a young acquisition officer there. I had this deal in Playa del Rey, and I think I listed it for sale shortly after I was acquiring it because of the value proposition in it, and you came to look at it, as I recall, and I think I invited you to our office to sit down and talk about it. And you showed up. You had a lot of swagger, as I remember.
Oh, you're being so kind.
Well, and at the time, unfortunately, KW stock was not trading at a very good price. And I was sitting there with one of the senior executives who was my boss at the time. And I think we were trying to solve for a price of the property for about 28 or 9 million, as I remember.
I thought it was a little high.
It was a little high. Well, I bought it for like 24, 25. It was one of my early good deals.
It was a very good deal.
And I'll never forget what you said. Can I tell the viewers what you said?
Sure, why not?
So Larry, in his infinite wisdom, decides that, maybe I'll test these guys a little bit. He said, we finally asked him, we said, are you going to buy this property or not? He goes, well, I've been thinking about it. And he said, why should I buy the milk when I can buy the whole cow? Meaning you could buy the whole company, which was at that time maybe worth, what, $50 million?
It was $1 a share. And maybe there were 38 million shares outstanding. So for 38 million, you can buy the company. Why buy the building?
So our jaws dropped. And we said, the company's not for sale, Larry. In fact, we'll get back to you.
It was a very short
It was a short meeting. So I learned something then, Maybe the whole is worth, it's better to buy the whole than just the parts.
But I did the same thing with Federal Realty in 2001.
You did?
2000 and 2001. Because I was in a joint venture with them to merge my retail portfolio into their street retail portfolio. They were pivoting away from grocery anchored shopping centers to street retail. And I had met their chairman, Steve Gutman, who was a visionary, and he was really focused on street retail. And I had plenty of street retail. I had Westwood Village.
Highly
I had Beverly
walkable
Hills.
retail.
Yes. Prime, walkable, downtown, urban, high quality, high end luxury
And that's
retail.
consistent with things that you've been doing over the years.
Always.
Whether it's in Santa Monica, whether it's at Larchmont,
Beverly Hills,
and
Westwood,
Beverly Drive,
West
Westwood.
LA,
It's that
Brentwood.
all this sort of high walkability, high visibility street retail.
Right, and there was a strategy to it, which is it's triple net leased, which has the same similarities as industrial real estate. So the tenants are paying all the expenses. But you have the sex appeal of really high quality real estate, which is always going to bring a higher price and more buyers.
Yeah.
So I was really into it. And so I was introduced to Federal Realty, and we put together a joint venture that was CDC SRI, Street Retail Inc., which was their subsidiary, and Christina. And it ended up being a conflict with another joint venture partner that they had in LA.
Is that right?
Yeah.
Who was that?
Can
Can't
I say it?
Huh?
It was CIM.
Oh, it was CIM at the time.
So I guess you weren't supposed to piss those people off, and they found out about it, and we tanked that deal. But I got to know the chairman of the company. Now I'm looking at the stock, and the stock is doing terrible. Terrible. And I was going to dump my real estate into this venture.
Into Federal.
And take stock.
Really? So
Yes. I was a roll-up and an exchange for stock. So I was very focused on the stock.
That
And
was kind of a big deal for you, wasn't it?
that would have been about $700 million.
That's a big deal.
That was
Even by
big.
today's standards, that's a big deal.
That would have been a big deal. But it didn't happen.
And the defining event was?
The defining event?
Yeah.
The defining event was that they already had an exclusive with CIM.
And that's what killed it.
And going into an exclusive with me would be a breach of that.
Okay.
But in the meantime, having become very familiar with the 145 properties that they owned, I really did my due diligence on the portfolio of this public company, and I loved their real estate. And the guy that ran it, Steve Gutman, was like a real estate guy. He was on his knees in his office looking at signage drawings for like the latest shopping center that they bought. The corporate offices were in a abandoned bowling alley in a shopping center that they owned, so the corporate rent would be zero.
Wow.
And it was close to the country club. So I mean, I was very, very engaged. And one day I said this was Steve Gutman, I said, so I see that you're going to split off the street retail from the shopping center business and sell your shopping centers to Regency and then split off street retail. So that deal, if you really boiled it down to, was still about $24 to $24.50 a share, right? I said, I know the guy that runs Regency. I've met him. I don't think you guys will ever close a deal together. Personalities will not work. And I don't know that you'd be successful floating a street retail publicly traded company. I just didn't see it. The deal cratered. The stock went down to 19.
Yeah.
And I said, I want to buy your company, just like I did when I first met you.
Yeah. It wasn't my company, though.
I called him up and I said, you know, Steve, I'll buy the company for $24.50 a share. That's what you would have gotten if the deal went through. And he said, well, I want to buy the London Bridge. Where are you going to get the money? And I said, if I can get the company, I'll get the money. So,
well, Larry, you have a lot of
another story.
You have a lot of moxie, as they say. So, in the course of your developments and redevelopments and so forth, tell us about how you've tried to build better communities. You just did that in Larchmont. You've done it in many ways. Talk about that a little bit. Talk about the projects a little bit.
Okay, well, I think I have a knack for identifying areas that might have been great at one time that have fallen or that never really had a chance to come up. So
Or
I've
where the
always
retail might have been, the real estate might have been neglected a bit.
neglected, or, you know, an area that might have been popular at one time, but, you know, over time, generationally, things had changed and people had moved on. But I always looked at areas that had been ignored, like South Beverly Hills, when I was looking at all of this old retail that was
South of Wilshire.
Olympic, Doheny, just South Beverly Drive.
Yeah.
These areas that were not
Sleepy.
And I would go in and essentially hire the best architect I could find and go there with a vision and kind of recreate it. So back in 1984, I bought a building in Beverly Hills. It was a body shop. And I went, oh, well, that would make a great retail shopping center. But there were no retail shopping centers on Olympic Boulevard. And I said, well, this is pretty...
No, there weren't, were there?
I said, this is pretty easy. Just tear the garage doors off, put storefronts in. You already got parking in front. And besides, I'm going to buy it at a price that if that doesn't work, I can just tear it all down.
Which block was that?
Olympic and Oakhurst. I sold that one to...
On the
Steve
south side
Gordon.
of the street?
Northeast corner.
The northeast corner. Okay.
Yeah. And so...
Near Doheny.
Yeah.
Yeah.
One block west of Doheny. So it was just things like that. And then whenever I would go there and kind of do something that no one ever thought of, other people started to get the idea. And so then that area started to blossom, and I bought like 4 or 5, 6 or 7 parcels in that area that are still there today, standing, doing great retail. The old Earlshire paint shop.
Was there?
That was me. That's Beverly Palm Plaza. All I did was tear the garage doors off and reimagine it as a shopping center.
Very, very creative. So it was an early form of adaptive reuse and ESGs all at once.
It worked. And so,
It worked.
you know, again, in like Larchmont, which we started working on a few years ago, Larchmont in 1921, when it was developed with a streetcar in the center that used to actually go up and down the street, and it was to service Hancock Park, which had become the new kind of, you know, exclusive neighborhood as people were moving, you know, out from downtown LA.
They kept moving west.
They kept moving
The
west.
city really grew from downtown, Silver Lake,
Yeah, concentrically
Park,
out.
Beverly Hills, west.
Right. West. And so, you know, this area was 100 years old. The homes in Hancock Park, elegant, beautiful.
Large.
Wilshire Country Club was LA Country Club
Yes.
originally. And Larchmont was the neighborhood shopping street.
It was kind of like the Rodeo Drive before there was Rodeo Drive.
No, actually, it was much more of a neighborhood servicing,
Okay.
dry cleaners, grocery,
So not
drugstore.
as that fancy.
It wasn't fancy. Fancy was up on Wilshire Boulevard with, you know, Bonwood Teller and Bullock's.
Yeah.
Bullock's Wilshire down there. So, but Larchmont was a neighborhood serving, just like a retail
Community.
district. And the same thing on Montana Avenue in Santa Monica.
Similar to how Westwood was in its early days, maybe.
Yes, well, Westwood was an interesting situation because all of Westwood was owned by one family. And Westwood was owned by the Jans family originally and then sold to the Bornsteins. And Manny Bornstein, may he rest in peace, had no vision. Whereas J.J. Labonte, that developed Larchmont, he actually envisioned this shopping district with the streetcar and all of these things, and he went bankrupt, unfortunately, in the Great Depression.
Oh,
But the first building that we bought on Larchmont was actually the first building that he built on Larchmont.
is that right?
Yeah.
Wow.
And he
You've
ran
gone
his
full circle
building,
with
and he
these
ran
folks.
his building and loan there before there were savings and loans. Did you ever see
A
the
building
movie?
and loan?
Did you ever see the movie It's a Wonderful Life?
Of course.
The building and loan.
Yes.
The safe is still in that building.
You're kidding me.
I'm not kidding.
Oh my God.
I've got stationery from J.J. Labonte Building and Loan
You got
because
to
I
create
bought
a
it from
time
the original
capsule.
family.
Well, as we're wrapping up here, I just want to. We talked about all these eras from the '70s forward. We hit the great financial crisis in '07, '08. We come out of it in '09. It was a very tough period. It was caused by mortgage-backed derivatives that were defunct because of too much housing finance and so forth, single family. But we come out of that like a freight train into '10 and '11 and beyond. And this freight train goes on for right up until just past COVID, 21. It's a 10-year run,
Long run.
a long run. How does your strategy evolve in that period?
Well, again, whether it was good fortune or intelligence, I was out of the market by 2008. I'd sold the last property, which actually was here in Century City at 10,000 Santa Monica Boulevard.
You sold that land.
I closed that deal, I think, in early 2007.
That was the old Michael's site, wasn't it?
Jimmy's.
Jimmy's, sorry.
Jimmy's, yes. And I had sold a lot of other properties by then. So when 2009 came along, we had a very tiny portfolio. We'd had a lot of the staff leave because there was less properties to manage, and I was excited about the possibilities as if it was 1991. But that didn't happen, if you'll recall, in 2009, 10, 11. There were opportunities, but it wasn't like that.
Well,
there was
people
no
ask me
RTC.
about that, and I say to them, it was a 7 cap for 7 minutes.
Exactly.
It did not last very long. It was a very short party, which is, maybe it's a page to be taken out of the book today, because we've had a stoppage in the market due to high interest rates. The robustness that we saw has gone. Cap rates have crept back up. You have a lot of factors in this lower transaction volume. But the question is it go on? Do you jump back in early? How do you relate these cycles to today?
They're always similar, and they're always a little different.
Yes.
This
Well, they have
one is
different
different.
cause and effects.
This one is different, but what we started doing in 2011, 2012, 2013, we were studying how the evolution of how people invested in real estate, going from syndications to funds to publicly traded limited partnerships to REITs. REITs came and went, and then in '91 they came back because you either went bankrupt or you went public. That was the motto. Avalon, either bankrupt or public. Bay, either bankrupt or public. A good friend of mine actually took them public and merged them.
Really?
So we've gone through these transitional periods. In 2012, 2013, I'm studying the fund business because I never understood the fund concept because I had to have the deal before I could get the money. That was the way it worked.
And Christina has evolved into being a fund manager now.
We don't like to call ourselves a fund manager. We like to call ourselves sponsors of real estate investment companies.
Okay.
I always like to be a little different than the masses because
Okay.
I've seen the structures come and go.
Yeah.
And I wanted to be in a structure that was enduring. So instead of a fund, which has a defined life, it made no sense to me.
That's where the departure comes from.
Right.
But it's still when you're starting with a subscription and a blind pool.
Yes. Right. And I learned that by studying the fund business and personally investing in funds so that I could do two things: see what the experience was like, and also to get the documents so I could copy them for my own use. It's a lot cheaper to copy a good one than it is to hire a lawyer to do it.
Yes, it is.
So it's an evolution. And so now I feel that sponsoring real estate investment companies where you have a defined amount of capital, you buy a defined portfolio of real estate, you own it, you operate it, you build wealth, you mine it for its tax benefits, and you opportunistically sell it when it's in your best interest. But you don't have a defined date that you have to sell everything,
Yeah.
which is a fun concept. So it's a morphed
Well, I think
concept.
that concept can work better with private equity than it can with institutional equity.
100%.
Institutional equity typically has a time fuse on it. Larry, we've covered a lot of ground. You're a wonderful person, and you've been a huge supporter of Los Angeles and really a native son of the West Side. How do you want to be remembered as you think about the future?
It's a great question. I never thought of it, but I do want to be remembered as somebody that actually had the vision to look at things differently than somebody else and say, that's a possibility, we can do that. Instead of, that's impossible. As soon as I'm told it's impossible, I'm interested. As soon as I'm told it's possible, I'm not interested. So I want to be remembered as the person that can actually take the impossible and make it possible.
That's great, Larry. Larry, you've been an incredible timer of markets. You've seen things change before others have seen them change. I think that's from being in the business so long and from just being a good investor. So you've done a great job in that. How do you see that today in terms of your own strategy and in terms of timing?
Well, this time around, my strategy is affected by the environment that we're in, because the strategy that we gave birth to 9 years ago, 10 years ago, which is to buy it, own it, keep it, hold it, manage it forever, essentially. It's not a great time to be holding a large portfolio of real estate in a market like this where, maturities are an issue and interest rates are moving in 11 increases in a row. But on the long run, because I'm looking out over a long period of time, I just see it as, again, opportunistic. There's more deal flow now than there was last year.
There is.
And we're going to take advantage of that by continuing to deploy capital opportunistically, because there will be a shakeout. In that long run-up that we've had, we just talked about, this is the longest run in our careers.
People were asking, what inning are you in? We stopped answering that.
Yeah, it just
a double header.
It just kept going. But I think that there'll be a major shakeout, and that's an opportunistic time for us to be looking to acquire the equity. And a lot of people right now are very much into the debt side as a way to get to the real estate. But the real estate is starting to show up. And it's just another opportunity to buy really great properties that have been built over the last 20 years on the West Side, which is built up, and take advantage.
So you haven't changed your focus?
No, I'm just hurting.
Timing it differently.
I'm just hurting a little bit because this is the first time that I have to deal with an existing portfolio that's in a market where the market conditions aren't as good as they were 10 years ago.
That's the beauty of long-term capital.
Got to keep waiting.
That's right. Larry, thanks for being on the podcast. You were a great guest. Wonderful to know you, wonderful to do business with you, and you've had a remarkable, iconic career.
Thank you, Bob. It's a real pleasure to be here with you, and thank you for the opportunity.
Thank you, Larry.